To calculate cash flow, we can start with sales, from which we subtract expenses. Alternatively, it could be additional income minus additional expenses. You can also think of a scenario where you have savings minus expenses. Irrespective, once you're done with this calculation, we end up with earnings before interest, depreciation, and tax, after which we subtract depreciation. We get ourselves earnings before interest and tax. Next step, we subtract interest and we end up with earnings before tax, which you can also call net profit before tax. Now we subtract tax and we get ourselves earnings after tax, also called net profit after tax. Now, in order to reach cash flow, we need to add back depreciation. We subtracted it from earnings before interest, depreciation, and tax because we get a benefit, a tax benefit from the subtraction of depreciation. Now that we have charged tax, we can add back the depreciation. And doing that gives us cash flow. And cash flow is used for various investment, appraisal, or capital budgeting methods, which we'll be looking at in other videos. To keep a shorter version using only short forms, which I wouldn't recommend you do in an exam, just for your understanding, if we are starting with sales and we end up subtracting expenses, we end up with EBIDT, earnings before interest, depreciation, and tax. From this, we subtract depreciation. We end up with earnings before interest and tax. From this, we subtract interest. We end up with earnings before tax. Then we subtract tax. We end up with earnings after tax, or net profit after tax, or simply profit after tax. Similarly, this can be net profit before tax or profit before tax, all the same. Now we add back depreciation and we get cash flow.